Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Tuesday, April 2nd, 5:03 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. State of the market, we're in an uptrend. You can see the trend gauge over here. We've got the four green arrows. A couple of reasons to be concerned. We've got a yellow sub arrow on leaders as they're taking a break, most not making new highs. They've been pulling back for the greater part of the last month. Uh, no significant damage done or major blowups, but there are some things to be concerned about. We'll go through a couple of them in this video. And also, we've got the small caps closing below the 21-day moving average today. So the yellow sub arrow is out on our short-term trend indicator. NASDAQ 100 undercut, but closed right on the 21-day moving average today. The rest of the all five of the major indexes are above their medium-term 50-day moving average and long-term 200-day moving average. So what happened today? In last night's video, we pointed out two causes for concern, that being rising yields and a strong dollar. And overnight, yields broke higher to 4+ month highs, breaking out of their recent trading ranges. 5-year, 10-year, 30-year, they were all higher, meaning the price lower. Dollar didn't add to its recent gains. It pulled back a bit, but this was enough to make the indexes have a serious gap down. S&P 500 gap down 9/10, Russell 2000 down 1.3, NASDAQ 100 down 1.1, but no significant further progress to the downside. The index is put in a 5.5 hour base and closed near the high of the day with a little bit of strength into the close. A lot of the leaders, while closing red, put in what are called hammer candles, meaning closing at the high of the range for the day. So a day like today from a trading standpoint marks an inflection point. Today's lows are critical. When you test the downside, don't go any further down, and then bounce off of that downside low. That low makes a very good line in the sand for not only the indexes, but also for individual names. And then certainly names that were green today need to be at the top of anybody's watch list. We've got about a dozen or so that we're going to go through that showed good strength today. So inflection point, all red, but off of the lows. Here are the final numbers. The big seven held up pretty well, only down 1/3%. Meta strong all day and green most of the day, up 1.23%. RG8, on the other hand, not so good. All eight red, down 1.71%. S&P 500 closed down 0.72, was down over 1.1% at the low of the day after the 0.9% gap down. Equal weighted, just a bit worse, down 0.86%, which was the same return as the NASDAQ 100, down 0.86%. Again, closing higher like the S&P, closing higher than where it opened on the gap down. Equal weight, NASDAQ 100 down 1.1, Dow down 1%. Mid caps down 1.3, Russell 2000 weak all day down 1.8. Higher yields are just a kryptonite to growth stocks, particularly small growth stocks. Global 60/40 down 0.38%. In-house GROTECTION down 0.68%. Half of our individual names were positive on the day. We'll run through the portfolio. Some really nice relative strength in some of the names, and we'll also discuss the ones that held up that we don't own, that certainly get moved to the top of our watch list after the action. So here's the S&P 500. You can see we didn't even touch the 21-day moving average today and closed at the top of the range. Let's bring up the 5-minute chart. Here's the gap down. Obviously not good. But then we made the bottom early morning, and then you call it a flat base, you could call it a cup with a longer handle, and then broke to the upside above 5,200 after 3 o'clock. As usual, you want to back test the pivot. We did, the pivot in this case being around 5,200. We undercut it and then had some more strength into the close. So a decent close, not bad. And This action is what you saw in a lot of leading stocks too, some undercutting and reclaiming the 10-week or 50-day moving average, some doing the same to the 21-day moving average. The real leaders are still above the 8-day moving average, and there aren't many of them. Mostly, well, unless you're looking for oils, you'll find a lot of them there, and also some other commodity names. So there's the S&P 500. Here's the NASDAQ 100. Let's look at a 5-minute chart here. There's the same gap down, a cup with a handle, and then strength into the close, and it closed within 2 cents above the 21-day exponential moving average, and that makes today's low pretty critical. Right below today's low is the 50-day moving average by well, where we closed today, the 50-day moving average is only 1.4% below. Let's take a look at the S&P and see where it is. As you know, we've been talking about how the relative strength of the S&P, because of the sector rotation, has been holding up much better than the NASDAQ 100. S&P is 2.8% above the 50-day moving average. Still holding this Fed breakout above that 51.74 pivot point. So this is day 9. We bounced off the bottom of the range today, bottom of the range at 51.84. So still 10 points above that 51.74 pivot at the low today, and then closing at the high of the day. Here's the Dow. The Dow actually closed, but I thought it was back above, but no, it closed below the 21-day moving average there. Must have faded a bit into the close. Uh, Gap down. A lot of the healthcare stocks, there's an unfavorable Medicare ruling that hit some of them, and United Healthcare is a very highly priced, and the Dow is a price-weighted index. On to mid caps. Here's MDY below the 8-day, but didn't touch the 21, still showing some good strength there. Small caps closed about mid-range and below the 21-day moving average, still above the 50-day moving average. Let's go to the VIX. VIX wide range today was didn't quite hit this 16 level. It's back below 15 by the end of the day, right on the 200-day moving average above the 50 and the 21. This is kind of a normal bounce with some volatility in the volatility because people are getting scared because of the yields breaking out, and we'll get to yields in a second. Here's the dollar. It's a tight range today. And inside yesterday's candle. So you can see this 105 area here. No further progress to the upside there. 105, you can see price bouncing around it last fall before a breakdown in the dollar in November, and that really kicked off the big run up in stocks. And that 105 level could provide some resistance here, and that's what it did today anyway. All right, now on to bonds. BND closed at the top of the range if after gapping down. So that meant that yields, which gapped up, closed at the bottom of the range for the day, but still broke out. You can see this in a minute. First, we'll do TLT, undercutting the range, but closing at the high of the day. Now, let's go. Here's the yields, and you'll see what I'm talking about. So here's TYX. Clear breakout above this level going all the way back to November. The question is this going to be a failed breakout, or are we going to pull back near this 45.05 pivot, bounce around, and then go higher, which would be bearish for stock? So that's really one of the main things we're looking for here. But this pullback, this is a kind of a wedge pop formation. We pull back and then strength off of that. In this case, the 21-day moving average, and then some follow through today with the gap up, but faded as the day went along, and the indexes got stronger as yields pulled back a bit intraday. So there's the 30-year. Next up is the 10-year. Really the same formation, breakout above recent highs, but near the lows of the day. Here's the 5-year. Closed back inside the recent range, or right at the top of the range, but still, these are the highest yields that we've seen going back to late November. Gold, silver, and gold and silver stocks have been strong lately. What about today? Yes, gold continuing higher, up 1.5%. GDX, gold stocks up 1.3%. Silver, the big winner on the day, up 4.29%. This is a 227-day base that this is forming here. That has a similar wedge pop, very much like yields did. And look at the volume on silver today, 226% above average. So this has our attention now as well. Bitcoin, as strong as the metals were, Bitcoin was weak today. Well, I need to show IBIT because it closed basically almost right on the 21-day moving average, near the top of the range for the day, after gapping down, but still down 5.41% on the day. All right, that is the inter-asset correlation. Let's get to the tail of the tape. You can pause this. I'll hit the highlights. So yields break out, 4-month highs. 4-month highs, we talked about that. Day count, 9-day consolidation since the breakout on the Fed. First day back below the 8-day exponential moving average on the S&P. Day 58 above the 21. 5.5 hour base, closed near the highs of the day. We already covered all that. So standout sectors today: oils, utilities, gold, and silver stocks, uranium. To the downside, builders because of the interest rate ticking up, semiconductors, biotech, banks, mostly regional banks, and then retail, especially luxury retail. We'll talk about this in a minute, but basically, actually, let me cover it now before I forget. So basically what happened is PVH, which is a luxury retailer, they make Tommy Hilfiger, and they warned down 22% on the day. Look how strong this has been. Luxury retail has been one of the leaders, one of the leading sectors during this bull run. This was kind of foreshadowed a little bit with Lulu's weak earnings. Lulu not as big a leader as PVH had been, but you can see the gap down on earnings on Lulu. And then this trickled through to other quote unquote luxury retailers in the sector. Ralph Lauren down 4.5%. That was a leader that broke the 21. Tapestry, TPR, they make luxury handbags, I believe, down near the bottom of the range, down 4.2%. Deckers, more upscale footwear, Uggs and Hoka, breaking the 21-day moving average, down 2.9%. So keep an eye on luxury retail because it certainly did not look good today. And XRT, the broad retail sector, went from highs to breaking the 21-day moving average as well. So everybody's been saying the consumer's been holding up well. If we're starting to get weak numbers like this could lead to the Fed cutting on the. But again, they can only cut short-term interest rates. The longer term going higher. They kind of tend to move together, but the Fed has no control over the longer term interest rates. The market sets those. And if we're starting to finally see some weakness in retail, that could lead to the Fed cutting. And ironically, that would be good for the market. So there might be some short-term pain that might end up in a longer-term gain, or we could just pull back maybe to the 50-day moving average on the indexes, or we could go into a correction. We don't predict here. We've got stops in place every time we buy something, and we're just going to do what the market's going to tell us. And today it told us it's an inflection point. We went down. There was no further move down after the gap down. We're holding that breakout level on the S&P, that 5174 level from right here. This was Fed day. We tested it today. The range is really 5174 to 5190. We poked our nose below 5190, stayed there for about a half an hour, and closed at the highs of the day. So this makes this a critical. Today's low is pretty critical. Let's get now to, well, back to the tail of the tape. What did I miss? Okay. Portfolio changes. We sold Gap. Gap was down early in sympathy with all the retailers being weak. We bought Kava. We've been wanting to get into this, and I can't tell you how many times I look back. I have a stock entry, and I see it bounce at the 21, and I say to myself, "Well, why the heck didn't I get into this off the 21?" Well, very often when you see something like this, it's on bigger weakness on the day, and it immediately bounces at this key level that you wanted it to, and that's what Kava did today. So finally able to get a starter in Kava today. GPS breaking that 8. It hammered as well, closed above where we sold it, but basically we hit our stop down. let's see, this was a 1.5% position, and we were down about 8% or so on it. So replaced gap with Kava, trimmed UWM, that is the index for the Russell 2000, and we added to Micron MU, lower volume relative to recent, above average on the day, but a nice tight range, didn't break the 120 level. This has major leadership characteristics. Look at the $7.24 cent earnings projection for 2025. That's an 1,875% gain off of the 37-cent EPS projection for 2024. So this is flashing the capability, if the market agrees, that this can go much higher. So adding to that every opportunity that we get. We added some yesterday. We added a little bit more today. So bottom line, basically our exposure is where we ended the day yesterday, 1.47 versus 1.48. And the bottom line on the day, yields break out, index is all red but off lows, and leaders hammer. Let's take a look at some of those leaders. First, we'll hit the portfolio, and then we'll hit about a dozen or so that finished green today. So standouts today. Start off with VDE, the energy ETF. We added that yesterday. That followed through to the upside. Nugget, this is gold. The 2 times gold miners, up 2.6%. FCX continues to power to the upside. That's copper up 2.2%. Lilly finished positive on the day, closed right on the 21-day moving average. Anything closing positive on a day like today, pretty happy with it. Here's Uber, also positive, bouncing off the 50-day moving average. Now to the downside, CrowdStrike closed down by a penny. Very happy with that. Undercut and reclaim the 50-day moving average. And our biggest position, NVIDIA, not bad. Bounced off the 21-day moving average just the way you would want it to. You want leaders to hold, and look at how the volume is drying up the last 3 sessions on NVIDIA. Now, what finished positive today? Uranium's making a comeback. Here's CCJ. Made a higher high 2 days up in a row. And here's the sector ETF, uranium, also higher high. This was down most of the day, but with a strong finish. So some other things that were positive today, Meta was green all day. Amazon looking good. Just not green, but only down 0.15%, undercutting and reclaiming the 8-day exponential moving average. Interactive brokers up 2%. Looks like all-time highs there, or at least 52-week highs. Spotify, very strong, above the 8-day exponential moving average. CEG, alternative energy stock, tight range, up 1.2% on the day. AppLovin, it's one of the few tech names that really hasn't gotten taken apart, or not taken apart, but hasn't showed relative weakness. You can see the relative strength line since the gap up there, and continued strength today, up less than 1%, but hey, it's up. GoDaddy continues to act well, up a little less than 1%. Cart, Instacart, Maple Bear is the dumb name for the corporation, up 0.65%. When you have a brand like Instacart and you want to call your corporation Maple Bear, I mean, where's the marketing company telling them how that doesn't make any sense? Vertiv VRT bouncing at the 21-day moving average, positive on the day. And Marvell Semiconductor acting well, up 3 of the past 4 days, 4 of the past 5 days. On the other hand, AMD not acting as well, closing below the 50-day moving average, giving up the gains of yesterday. I want to take a look at ARM, also down beneath the 21-day moving average as well. So pockets of strength. Strength is revealed in the pullback. Green stocks or hammering stocks that undercut and reclaimed a key moving average today should all move to the top of the watch list. And today's definitely an inflection point. You want to see how things play out, but today's lows across the board, pretty critical, as we had the opportunity to sell off, but we did not. Also need to keep an eye on interest rates and the dollar. That'll definitely have an impact on things. So that's going to wrap it. My email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932 if you're interested in becoming a client. And now is the time to become a client. Let me tell you why. Bull markets make a genius out of all advisors or people that are running their accounts. And as William O'Neill said, anybody can get you in. Who's going to get you out? Our downside is about 3% right now before all of our stops trigger, and we then collect our thoughts and watch how things play out on the market. The time to come to Revere is not after you've lost 25 or 30%. The time is when your account is in a strong uptrend and you need a plan to keep those gains. And we got one. And reach out to us. We do two things. We grow assets in uptrends. We protect assets in downtrends. No bear markets here at Revere. There've been three since 2018. Zero. We don't say we never lose money. We certainly do, but we know when the market's healthy and we know when the market is risky. And things go from healthy to risky little by little. They start by breaking the 21-day moving average, then the 50, then the 100, then the 150, then the 200, and you just don't sit there like a deer in the headlights thinking or hoping it's going to come back because you read or heard somebody say something. Price is the only thing that matters. So give us a shout. We'd love to hear from you. And let's see, I guess with that, I will wrap up the video for Tuesday, April 2nd. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.